Hey guys, how's it going? I'm Josh. I'm a bookkeeper, and today I'm going to teach you how to set a basic financial budget for your business. And I would like to start with this quote: "You can't improve what you don't measure." And budgets for a business is how we measure our performance for a business. And once we measure our performance, and we know the money that's going in and out of our business, we can ultimately improve our business and get some of that money for ourselves. So I like to think of creating a budget for your business is kind of like creating a budget for your house. Inside your house, you have your job as your main source of income, and you have things like light, rent, utilities, expenses, water. And it's the same for your business, except there's a little bit more to add to it. So these are the basic financials that you need to understand inside your business in order to create your budget. So these are going to be your sales, your cost of goods sold, your gross profit, your total operating expense, your operating profit, your taxes, and your net profit. And if you notice, all of these is going to appear on your P&L and your profit and loss statement at the end. So I'm just going to go ahead and break down what each description means. So the sales is the money that you're making from selling the product inside your business. Your cost of goods sold is the cost of the materials that it takes to create the product inside your business. And if you take sales and cost of goods sold and you subtract the sales from the cost of goods sold, you get your gross profit, which is going to be the money you make before the rest of your operating expenses. Then you have your total operating expense. So your operating expenses are going to be the expenses that you need to operate your business, but it isn't the materials that go inside the product that you're selling. Examples of operating expenses are like rent, electricity, utilities, insurance, and they're usually fixed. They happen every month and they have a certain price point, so they're easy to track. But what's not fixed and what's not a fixed cost are your costs of goods sold. Since your sales are going to go up and down every month, your cost of goods sold are going to match the number of products that you're selling. But after you take sales and you subtract cost of goods sold and total operating expense, you're going to have your operating profit, which is going to be the profit you have after operating your business. And the last thing we're going to take away is taxes because you have to pay taxes to the country and the government. But after your taxes, you get your net profit, which is going to be the actual money you're making at the end of the month. And you can take that net profit, you can either put it back inside the business, which is going to be retained earnings, or you can pay yourself. And like I said, this is really is gonna break down into the profit and loss statement. So here you have your revenue and your sales, services revenue and other revenue, but this is just sales and or revenue. You have your cost of goods sold, which is the materials that goes directly in to the product that you're selling. You have other income, which could be other sources of income that doesn't go inside the business. So let's say if you get a grant or something, that would be termed as other income, and you can put that on your profit and loss statement. But then you have your operating expenses, kind of like your bank fees, your entertainment, your shipping or freight and courier, your insurance, your utilities, your vehicle expenses, office expenses, rent, payroll, travel, or general expenses. And this is what's going to go inside your budget, but we're going to break it down into something simple. And the thing that separates a basic P&L statement from a budget is just the accounting period. For example, it's just a duration of time that you choose to sell your product. It could be a week, a month, or even a year. So, for example, if you plan to sell 100 t-shirts every week and you start your week on Monday and you record how many t-shirts you have left on Sunday, Monday through Sunday would be the accounting period. Usually people do it by month, like these are the sales I made in January. These are the sales I made in February, and these are the sales that I made in March. And once you add the terms, which is the basic financials inside your profit and loss statement and the accounting period, you get something like this, which is just the items that you're selling, how many you're trying to sell them for, or how many items you're trying to sell per month, and the price of the item. broken down and you have your goals set for each accounting period, and it creates a budget. And you're asking, what about the expenses? We add the expenses by taking the cost of the business beforehand, and we just put the duration of each time that we buy them in order to create that budget. And after we have the cost and the duration, we break it down into categories so we know where to put them on the profit and loss statement. And as you can see, this and this is different. Why are they different? It's because when you are first buying stuff for your business, you're buying stuff in bulk. So you're probably buying these things. This is probably about a bag of rose petals or a bag of Mountain Harvest, and it's going in your cost of goods sold section, but you actually have to measure it out to see how much it costs to produce one item to sell. And that's really going to help you tackle down how much money is flowing in and out of your business. So not only do you need a duration of each time you're buying the product, you want to break it down into how much money is going into each product that you're selling. And that way you can time when you need to buy something again, and it can help you plan for the future even more and make your financial projection or budget way more accurate. For a cost of goods sold, we're not going to sell everything in just one accounting period. It's going to take us a couple months to sell it. So that's why we're going to start with the term ending merchandise inventory. And basically, it's just the inventory you have left after an accounting period. So let's start from the beginning. If I plan to sell 100 shirts every week and I start on Monday and I record how many shirts I have left on Sunday, Monday through Sunday would be the accounting period. So let's say I sell 75 shirts and I have 25 shirts left. My ending merchandise inventory would be the shirts I haven't sold on Sunday. So it would be my 25 shirts that I haven't sold. And the next term that flows into it is beginning merchandise inventory. And it's going to be the product that you start with when you restart an accounting period. So let's say I have leftover shirts from Sunday. Am I going to throw them away? No, of course, I'm going to keep them to sell the next week. So the shirts I'm going to sell on the Monday at the beginning of the new week would be my beginning merchandise inventory. So that my 25 shirts that I didn't sell on Sunday, I'm going to carry that on Monday. So my beginning merchandise inventory would be the 25 shirts that I start with on Monday. And of course, if I only have 25 shirts and I plan to sell 100 every week, I'm going to need to buy a new product to be successful. So I call that new product your net purchase of goods. And it's basically the new products that you purchase to sell. And the important thing to remember is your net purchase could also include shipping or paying yourself inside your COGS, depending on the way you want to put it inside your profit and loss statement. You might pay yourself as an operating expense, or you might pay yourself inside the labor as a cost of goods sold. And then you might pay shipping as an operating expense, or you might pay shipping as a cost of goods sold. It really depends on where you want to put it. But the important part is making sure that now I have 25 t-shirts and I want to buy 75 more t-shirts so I can hit my goal of selling 100 t-shirts every week. And here's a visual example of what a t-shirt business could look like. So I have my little van here. And of course, this van would be equipment, it would be an operating expense. This mural, it would also be equipment, which would be an operating expense. But what would be cost of goods sold are all these t-shirts that I bought to sell. And to break it down even further with a different example, we have a tent that would be classified as equipment as an operating expense. All these tables would be equipment as an operating expense. But these paintings, if I purchase these paintings, they would be my cost of goods sold. Or if I purchase the canvases and the paint and I put my time in to paint the paintings, all the canvases, all the paints, and the time I put into it would also be categorized as cost of goods sold to really break it down from a visual standpoint. And you really have to forget not to pay yourself, especially if you're starting at a farmer's market or you're a solopreneur, you actually have to add the time that you put inside your business. The number that you add or how much you pay yourself doesn't really matter that much when you're beginning, but you want to make sure that the job you're doing, you give it a fair rate. So when you replace yourself with somebody else inside your business, you're paying them also a fair rate. So for example, I might pay myself $20 an hour for each painting, and I take 4 hours to paint this painting. So I know the time I put into it is $80 an hour. So if I hire somebody else to help paint it for me and they can finish it by copying and pasting, and I pay them $20 an hour, that labor cost would be $40 an hour for the painting for my cost of goods sold. Well, that's about it. And these are all the things you need to know to make a basic budget for your business. I also have another video really focusing on the spreadsheet aspect of the cash budget statement. So if you want to check it out, just click on the next video.